The silver market isn't just breaking records anymore. It is shattering the very foundation of modern commodities trading. As of late February 2026, we are witnessing a structural decoupling between the physical reality of silver and the paper contracts traded in London and New York. While the mainstream media remains obsessed with the stock market's volatility, silver has silently engineered a move that has caught even the most seasoned institutional desks off guard. We aren't just looking at a price spike, we are looking at the potential for a permanent reset in how this metal is valued. With spot prices oscillating near $90 an ounce after a historic rally, the question is no longer if silver will hit triple digits, but how soon the physical supply runs dry entirely. Welcome to Money Stalker. I am your narrator, and today we are diving deep into the most critical updates in the silver market for February 2026. In this video, we will analyze the recent explosion in silver lease rates, which have spiked to levels that signal a massive liquidity squeeze in the wholesale bullion markets. We will break down the latest data on the persistent global supply deficit, which is now entering its sixth consecutive year with no end in sight. We are also going to look at the massive divergence between institutional ETF outflows and the aggressive physical accumulation happening in Asia, specifically in China and Hong Kong. By the end of this deep dive, you will understand exactly why the current price action is being driven by industrial necessity rather than just speculation, and what the top analysts are saying about the road to $100. To understand where we are today, we have to look at the carnage and the triumph of the last few weeks. Since the start of 2026, silver has surged by more than 65%, following an already legendary 146% rally in 2025. This isn't just a meme rally or a retail frenzy. This is the result of a 5-year cumulative deficit that has now surpassed 900 million ounces. According to recent reports from the Silver Institute and major brokerages like Peel Hunt, the market remains structurally undersupplied. Even with silver prices hitting record highs, global mine production is struggling to keep up. Remember, over 70% of silver is produced as a byproduct of lead, zinc, and copper mining. You cannot simply flip a switch and produce more silver just because the price is high. You have to mine more of the base metals first, and that takes years of capital expenditure and permitting. Right now, the smoking gun for this supply squeeze can be found in the lease rates. In the wholesale bullion market, the lease rate is the cost to borrow physical metal. Normally, these rates are stable and low. However, in February 2026, silver lease rates have spiked into the 6 to 7% range for short-term tenors, with some spikes briefly exceeding 10%. This tells us one thing: there is a desperate scramble for physical delivery. When lease rates rise this sharply, it means that industrial users, the people making your solar panels, electric vehicles, and AI data centers, cannot find the metal they need in the open market and are willing to pay a massive premium just to borrow it. This is a classic signal of a market in backwardation, where the price for immediate delivery is higher than the price for future delivery. It is a loud, clear alarm that the warehouses in London and the COMEX are being drained. Speaking of the COMEX, we are seeing a fascinating divergence in the data. While spot prices have soared, institutional silver ETFs have actually seen net outflows of nearly 30 million ounces since the start of the year. On the surface, a novice investor might see this as a bearish sign, assuming big money is selling. But look closer. The metal leaving these ETFs isn't just being sold into the void, it is being reclaimed. We are seeing a massive migration of inventory from Western vaults to Eastern markets. In Hong Kong and southern China, shops are reportedly selling out of silver bars within hours. Jewelry manufacturers in Asia are shifting away from gold, which has crossed the $5,000 mark, and moving into silver as the poor man's gold. This rotation is creating a floor for silver that the paper markets cannot break. The industrial side of the equation is where things get truly explosive. Even though high prices have forced some solar manufacturers to thrift or reduce the amount of silver used per panel, the sheer volume of global solar installations is offsetting those gains. We are looking at a 2026 deficit forecast of at least 67 million ounces. But it's not just solar anymore. The 2026 narrative is being dominated by AI infrastructure. Every high-performance chip and every data center cooling system requires silver for its superior conductivity. Analysts are now pointing out that silver is essentially the new oil of the digital age. Without it, the green energy transition and the AI revolution both grind to a halt. This is why analysts like Keith Neumeyer are doubling down on their triple-digit price targets. Neumeyer has long argued that the silver-to-gold mining ratio is closer to 8-to-1, yet the price ratio has spent years at 80-to-1 or higher. As that ratio continues to compress, dropping from over 100 last year to the 50s today, the upside potential for silver remains mathematically staggering. However, it hasn't been a straight lineup. In late January and early February, we saw a historic crush, where silver prices plummeted nearly 40% in a matter of days. Many retail investors were shaken out, but the cause was technical, not fundamental. The CME Group raised margin requirements from 11% to 15%, forcing leveraged speculators to liquidate their positions instantly. This created a massive paper crash, while the physical market remained tight. This is a gift for the long-term holder. It clears out the weak hands and allows physical premiums to reset. As of today, February 25th, 2026, we are seeing a strong rebound in the Asian session, with silver clearing $91 an ounce. The market is ignoring the hawkishness of the Federal Reserve and focusing on the fact that, regardless of interest rates, the world is running out of physical silver. The macro environment is also providing a massive tailwind. With the nomination of Kevin Warsh as the next Fed chair, there is significant uncertainty regarding the independence of the Federal Reserve and the future of the U.S. dollar. Concerns over government debt sustainability and the ongoing de-dollarization trend are pushing investors toward hard assets. While gold is the traditional safe haven, silver offers the added kicker of industrial demand. We are seeing a flight to reality. Investors are realizing that you can print trillions of dollars, but you cannot print a single ounce of silver. As we look toward the rest of 2026, the technical indicators are screaming bullish. Silver is holding well above its 200-day moving average, and every major dip is being aggressively bought by industrial users and sovereign wealth funds. The cup and handle formation on the multi-decade chart has finally broken out, and the measured move for this breakout suggests targets well beyond $100. We are in the early stages of a commodities supercycle that will likely be defined by the scarcity of critical minerals, a category silver was officially added to by various jurisdictions last year. This designation changes the game, as it could lead to government stockpiling and further restrictions on exports from major producers like Mexico and Peru. In summary, the silver market is currently a powder keg. We have a 5-year supply deficit, record low identifiable bullion stocks, skyrocketing lease rates, and a massive shift in physical demand toward the east. The recent price volatility is simply the growing pains of a market that is trying to find its true value after decades of suppression in the paper markets. The smart money isn't looking at the daily fluctuations on the COMEX, they are looking at the empty vaults and the mounting industrial requirements. The main takeaway for today is clear. Do not be distracted by the paper noise. The physical reality of silver is one of extreme scarcity. Whether it is the AI boom, the solar revolution, or the collapse of trust in fiat currency, all roads lead to higher silver prices. If you are waiting for silver to return to $20 or $30, you are likely waiting for a world that no longer exists. The floor has moved, and the ceiling is still miles away. If you found this market analysis helpful, make sure to hit that like button and subscribe to Money Stalker for the most direct, fluff-free updates on the precious metals market. We are tracking these developments in real time to keep you ahead of the curve. Now, I want to hear from you. With silver hovering near $90 today, what is your price prediction for the end of 2026? Do you think we see $150, or are we due for a deeper consolidation? Let me know your thoughts in the comments below. Stay disciplined, keep stalking the truth, and I will see you in the next video.